Shut up, turkey. Anyway.
Psych. Welcome to a boring slideshow presentation. If you haven't seen my previous video, we talked about when it's appropriate to push your edge versus refine your edge. The problem is, it's impossible to push or refine anything that doesn't already have some sort of definition or rules of engagement. So what I wanted to accomplish with this presentation was to give some practical application that will suit both beginners who have yet to define their model, as well as intermediate traders who want to simplify and refine their approach to how and when they should engage the market. Some housekeeping before we continue. This is not financial advice, nor are the following examples meant to be complete and tested trading plans. I want you to use this presentation and the framework as a template for defining your own model's rules of engagement. This will be a framework for how and when to engage the market and does not include risk management, position sizing, and other details that inevitably need to be defined by you based upon your own backtesting, forward testing, and risk tolerance. And lastly, credit to where credit is due. Most of all that I have learned and adopted into my own trading has come from the free material provided by AM Trades and T-Trades, as well as, of course, ICT. You do not need to trade ICT or use any of the concepts taught by AM or T to apply what I want to express in this presentation, as you will see in my first example. But if you are looking for a robust model or concepts to add to your trading toolbox, I highly recommend these guys. With that said, we're going to use this tweet by AM in order to build a framework of top-down analysis, focusing and ordering our approach to the market from a macro towards a micro perspective, as well as a logic towards proper rules of engagement. He says, weekly and daily charts, this is where narrative is established. Hourly charts, this is where bias is confirmed. Minute charts, this is where entry signatures occur. No narrative, no hourly charts. No confirmations, no minute charts. No entry signature, no trade. In that order. So the logic is narrative, confirmation, entry. If there is no narrative or narrative is unclear, you do not continue to confirmation. You wait until the logic is confirmed all the way through before you press a single button. In this way, you are setting yourself up with the probability of being aligned with the direction that the market wants to move and removing unnecessary loss or risk of being offside or fighting against higher time frame order flow. Narrative, confirmation, entry. So let's define each stage of our logical flow. We say that time is fractal, so it doesn't need to be these time frames exactly. But if you are new or struggling, this is a great place to start. Under narrative, with a daily or weekly chart, where has price been and where is it going? Based on your higher time frame analysis, where is price likely to draw towards next? If unclear, wait until it is clear. Do not continue to the lower time frames looking for clarity. Once your analysis is clear and you have a target to aim for within your narrative, you may continue to confirmation. On an intermediate time frame, has a change in the state of delivery occurred in the direction of your narrative? Where does price not want to go? Once you have a narrative target, a confirmation on an hourly chart is your signal that price is aligning with and moving towards your narrative and target. It is also helpful to understand where price does not want to go. If price has already taken out an old swing low and has reversed higher, it is unlikely that it will need to return before reaching your target. Once you have confirmation, you may now drop into your preferred entry time frame in order to frame an entry. During your trade window, has your defined entry signature presented itself in order to enter into a position with a profit target and point of invalidation? Your entry will be very unique to you. It will depend upon what you are comfortable with, what is easy for you to observe, how your risk tolerance and risk management are defined, etc. But what this logic has helped to accomplish is that how you enter will be the least important part of your trade. Because you have aligned yourself with the narrative of a larger time frame order flow and have confirmed where price is likely to go and not go, all that is left is finding an entry that is most comfortable and obvious to you while managing your risk and your stop loss where your idea is no longer valid. When you take a loss, because you have such a defined and robust logic, you can easily journal and review your trade to see if there was a mistake in your reasoning or observations that you can easily correct in the future. Or the market did whatever the market wanted to do. You're not looking for perfection because it doesn't exist. You are defining an edge that repeats itself. So let's look at an example of how you might define your model with a very simple retail example, using only the MACD. Our narrative logic is very simple. On the daily chart, if the MACD is bullish, then long bias only. If the MACD is bearish, then short bias only. Once we have our narrative, we can continue to confirmation. On the hourly chart, if long bias, we wait for MACD bullish signal. If short bias, we wait for a MACD bearish signal. Once our narrative is confirmed, we drop down to the 5-minute chart for entry. If long is confirmed, wait for retracement or bullish cross with stop loss on the recent swing low, targeting 2R. If short's confirmed, wait for retracement or bearish cross with a stop loss on the recent swing high, targeting 2R. Very simple logic. Let's look at what each step looks like within the charts. Within our narrative, we have a bearish example. This is the daily chart of the S&P 500. After Monday's print, MACD turned bearish, which means that we will be looking for a short bias confirmation going into Tuesday. With our narrative defined, we can now continue to the hourly chart to see if there is confirmation. Here in the hourly chart, approaching New York Open, we have bearish confirmation. So now we can continue to the 5-minute chart to find an entry. Here on the 5-minute chart, we see that we are continuing to sell off. So after we close below a recent pullback, having bearish narrative confirmation, we enter on the close, covering our stop loss at the recent swing high and taking profit at 2R. Now, obviously, this is where your personality, intuition, experience, and risk tolerance are uniquely going to shape the way that you enter and exit your position. So make it personal to you. What this logical framework is helping to accomplish is putting your short-term trade within a longer-term trend. Your entry should always follow your narrative. Now let's take a brief look at how I would write one of my main models within this template. My model is based upon AM Trade's weekly range protocol, which again is available for free on his Twitter, YouTube, along with an incredibly clean and concise PDF presentation. The main purpose of the rules of engagement for my model is to filter out low probability days and only engage on days where there is a higher likelihood of expanding towards an intended target. So my narrative begins with the review of the economic calendar. I consider the economic calendar to frame my week around significant volatility drivers. I'll generally wait until the first high-impact news event to release before approaching the markets. Then, on a daily chart, considering notable points of interest and where price is likely to draw towards, I wait for price to engage internal or external range liquidity to frame a reversal and define the weekly profile. Since I'm looking for expansive days, when I'm considering the weekly profile, I'm simply picturing a single weekly candle that has an open, draws lower, and then reverses and expands higher when I am bullish, and vice versa when I am bearish. So generally, there is an opportunity for 1 to 3 of those days expanding towards an intended target. AM Trades goes into plenty of detail regarding this concept. By internal and external range liquidity, what I'm looking for is daily swing highs and lows in regards to external, and fair value gaps, inefficiencies, just gaps in price, essentially, for internal range liquidity. We now continue to confirmation. Once price has engaged internal or external liquidity on the daily chart, I can move to the hourly chart and wait for an hourly change in the stated delivery in order to confirm the weekly profile and define my bias and my target for the remainder of the week. Again, to put it even more simply, I am looking for the reversal of that weekly candle. Once the hourly chart begins to break its current trend or break out of its consolidation, we have a change in a stated delivery. After confirmation, I can expect price to deliver towards my intended target, which is usually an imposing range of liquidity and expanding over the next few days. With my narrative confirmed, we continue to entry. I usually stay within the 5 and 15-minute charts. My trading session begins at 08:30 and concludes at 11:30. If no entry signal is given within the allotted trading session, then I simply close my charts and let the day go. For intermediate confirmation, I consider the daily profile and volatility drivers. What did London session do, and what should I expect the New York session to do? I let high impact news play out beforehand, then consider where we are at within the daily candle. Has London already reversed? Then New York should continue. Has London retraced or consolidated? Then New York should reverse. Has London already left the station towards my target? Then I disengage entirely. If my logic has survived thus far and price delivery looks like it is in my favor, then I frame an entry towards logical profit targets and cover my stop loss where my trade idea is invalidated. Now that we've detailed my rules of engagement, let's see an example within the charts. So on the daily chart of the NASDAQ, you can see that I have added a screenshot of the economic calendar. There are plenty of volatility drivers for this given week, and we will wait until after CPI delivers to consider the weekly profile. The Wednesday following CPI takes the previous day's highs and then closes bearish, giving me a point of interest to frame a reversal. I also see swing lows below that haven't been engaged yet. So I am anticipating those to be the target where price is likely to draw towards once we have confirmation. We will also see later that ES will diverge with NQ on Thursday and take the previous day's high again while NQ fails to do so, confirming weakness. Lastly, we can define our weekly profile as a bearish midweek reversal profile and expect Thursday and Friday to continue expansion to the downside. So we've considered the economic calendar, we've engaged in external range liquidity at Tuesday's high, and now we've dropped lower and are anticipating a midweek reversal and a continuation to liquidity resting below. We have our narrative. Now we look for confirmation. Looking at the hourly chart on Wednesday, we see price trade up and above Tuesday's high. After engaging our point of interest, the change in the state of delivery marks the point of reversal, confirms our narrative, and defines our weekly profile and subsequent bias. Based on our midweek reversal profile, we will anticipate Thursday and Friday to continue bearish towards the lows observed on the daily chart, as well as these hourly lows generated at the beginning of the week as low-hanging fruit objectives. As we approach Thursday, we will again see the divergence with ES making a new high as NQ fails to do so. We've confirmed our narrative and defined our bias. We can now enter Thursday's trading session and look for an entry. Here on the 5-minute chart, before framing an entry and waiting for high-impact news to deliver, we consider the daily profile for intermediate confirmation. What did London do? London retraced higher, then reversed, so we should expect our session to expand lower towards our target, in this case being previous day's lows as the low-hanging fruit objective. At market open, NQ diverges with the ES while taking liquidity, so we can enter short, covering the high where price does not need to return to, and aim for previous day's low. At that point, you can scale out, leave runners for your longer-term downside objective, or cash out and re-engage should an opportunity present itself again on Friday. And that's it. Because we followed our rules of engagement and have structured our alignment from the top down, we put ourselves on side with the higher time frame narrative and have taken our chunk out of the market. And that's going to be it for this video. You now have a simple framework to craft the rules of engagement for your own model, giving you a systematic and logical approach that will become easy to internalize. Once you have a narrative where price is gone, where it is likely to go, confirmation, a change in the state of delivery towards an intended target, all that is left is to enter and manage your risk, knowing that you've done all that you can to position yourself with the highest probable outcome that your model can deliver. No narrative, no confirmation, no entry. Now, back to Out by the River, Chris.
Well, I hope that was as informative and boring as I thought it was going to be. Hopefully it was of some use. Until next time, good luck. Godspeed.